Hello everybody and welcome to our Q1 Investment Vodcast. Clearly this quarter has been particularly eventful, with the global outbreak of COVID-19 causing significant turbulence within investment markets. I will talk you through the performance of various markets and the key drivers of this. Let me first start by looking at equity markets. It is clear to see that markets reacted unfavourably to COVID-19 related news over February and March. Within the UK, the FTSE 100 was down around 25% over the quarter, and global equities, depicted by the MSCI World Index, lost 20% in value in local currency terms. What is important to remember is that the stock market is a gauge of investor sentiment within the economy rather than a primary indicator of the health of the economy itself. The economic outlook for the near term especially is very poor. Most economic forecasts predict record falls in economic output and growth over Q1 and Q2 of the year, and investors have clearly priced this into their equity valuations as a lack of production feeds through to corporate earnings. What is somewhat promising is that equity market valuations have risen since the end of the quarter, which would suggest that investors may have started to price in what they perceive to be the full economic impact of the coronavirus, although of course this is yet to be seen. If we look at government bonds, this particular graph shows the change in the UK government bond yield, both nominal and inflation linked over the last 15 months. This shows an overall downward trend. During Q1 specifically, the over 15-year gilt yield fell as low as 0.5%, whilst the over 5-year index-linked gilt yield fell further into negative territory, as low as -2.9% on the 9th of March. What is also interesting is the level of volatility that has been observed, as well as the divergence between nominal and inflation-linked assets. Inflation-linked assets have come under significant pressure due to the fall in the price of oil, the reasons for which we will come on to a little later. These movements are also true of other developed market government bonds, which have also experienced significant declines in yields. These moves are unsurprising, as demand for government bonds during periods of market stress typically rises significantly as investors seek greater security. The fall in the price of oil has also been a notable event over the quarter. Oil prices have been slashed by a fall in demand due to COVID-19 and the pricing dispute between Saudi Arabia and Russia. Oil prices fell even further since the quarter end, with West Texas Intermediate, which is the primary oil index for the United States, moving into negative territory for the first time in history, reaching a low of -$37 a barrel on the close of 20th of April. This was primarily caused by a lack of storage due to the fall in demand. Storage costs rocketed as a result, exceeding the value of oil per barrel, which pushed prices into negative territory. Investors' uncertainty can be gauged through volatility in financial markets. Volatility is a measure of the magnitude of price movements over a certain period of time. The best known measure of market volatility is the CBOE Volatility Index, more commonly known as VIX. The VIX index measures implied volatility in the S&P 500 index over a forward period of 30 days. It is important to note that VIX is not a measure of actual volatility, but rather the expected volatility that has been priced into option contracts. The VIX is also known as the fear index or fear gauge, as we can directly view the market's expectations of future volatility. The long-term graph of the VIX index on the left-hand side of this slide shows large spikes in the index at times of great uncertainty. For example, in 2008 with the Great Financial Crash, 2010 with the flash crash attributed to high-frequency traders, and 2011 with the S&P downgrade of US sovereign debt. As a rule of thumb, a value lower than 20 represents a low-risk environment, and values above 30 represent a high-risk environment. On the 16th of March, the VIX closed at a record peak of around 83, emphasising the market's current heightened uncertainty. We now move on to look at what the economic impact has been of this and how governments have responded. So I think one thing we can conclude is that a recession is inevitable. The International Monetary Fund estimates that global output will shrink by 3% over the year, with developed economies being hardest hit. The Chinese economy shrank 9.8% over the first quarter, and the UK and US and Eurozone economies are expected to shrink over the first and second quarter of the year. Global supply chains have been affected by COVID-19. Social distancing measures and travel restrictions that have been put in place in a bid to reduce infection rates have caused supply issues, as capital and people cannot move as freely as they could before. We have seen record low PMI data releases from many major economies over the past month, with services being worst affected in the UK. The virus has generally caused a supply-side recession in output growth. For many sectors, the demand is still there, but due to the restrictions that have had to be put in place to mitigate the spread of the virus, companies have not been able to produce the optimal capacity. Jobless claims in the USA have surpassed 26 million, which is far greater magnitude than the financial crisis of 2008. These have surged over a period of 5 weeks. Within the UK, nearly 500,000 firms have applied for the government furlough scheme, which covers 3.2 million of workers and helps to protect jobs that would otherwise be under threat. This does, however, need to be paid for by public finances over a number of years, which poses its own economic complications. Fears that the furlough scheme could just delay a surge in the unemployment levels are rising. It's difficult to comprehend and interpret this information as it has happened so suddenly. As the impact on economic productivity is expected to be relatively short-lived, we could see a reversal in these figures, but that's not to say this isn't very grim reading. The wider economic complications that unemployment data of this magnitude pose could be severe. Commitment in terms of pace and level of support from governments globally in response to this crisis has been unprecedented. We have seen emergency interest rate cuts in the US and UK and rates being held at minus 0.5% within Europe. The US Federal Reserve and European Central Bank have expanded their quantitative easing programs to provide further support. It became clear very early into this crisis that monetary policy alone would not be enough to solve the problem. We have seen large-scale fiscal stimulus added to this, including £330 billion of government-backed loans, £20 billion in cash grants and business tax cuts, and 3-month mortgage holidays within the UK. Within the US, Congress have agreed to a $2 trillion stimulus deal, the largest congressional bailout in US history. We've also seen a large-scale stimulus package within Germany worth over €1.1 trillion. Clearly, monetary and fiscal policy has helped to stabilise markets, but some economists are sceptical about the effectiveness of this in combating the COVID-19 recession. The virus has generally caused supply-side issues, and as fiscal policy measures generally affect demand, there are doubts surrounding the effect it would have in resolving a supply-side problem. On a more positive note, it is thought that many economies have now passed the virus peak. Some of the worst affected regions, such as China, Italy and Spain, have seen infection rates start to fall. And there are also early signs of promise in the UK too. The US is not out of the woods just yet, as certain cities are still reporting record daily death increases. Some civilians and politicians have resisted social distancing and lockdown measures. British scientists have made a start on human trials for a COVID-19 vaccine. Initial trials are due to last 6 months. Most commentators expect vaccines to become available in 2021. We've talked about what's happened so far over the year, so what's in store next? The full impact of COVID-19 is yet to be known. On this slide, we set out the IMF's growth forecast for 2020 and 2021, and this clearly shows growth rates are set to shrink sharply over 2020. Developed economies are expected to fare much worse off than emerging economies, and most of this negative growth is expected in the second quarter of the year, where we've seen significant rise in COVID cases. China has reported growth of -9.8% during quarter one of this year, the first time in 40 years it has reported negative growth. Now, the 2020 figures actually look fairly normal, but this is going to be largely dependent on what the recovery looks like from this crisis. What might the recovery look like? Let's explore 3 scenarios and the conditions under which these might present themselves and what that might mean for markets. V-shaped. This scenario has been commonly associated with natural disasters. With regards to the current COVID-19 impacts, such a scenario may rely on the virus being contained efficiently the first time round, coupled with stimulus that is sufficient to support a recovery occurring at a global level. The longer the current lockdown lasts, the less likely we are to see such a recovery, as company asset bases will continue to be eroded, if not exhausted. We envisage risk assets, such as equities, performing relatively well in such an environment, with the potential for recent interest rate cuts to be reversed over the medium term. U or W-shaped. These scenarios are common. A U-shaped recovery may result from the negative impact taking a period of time to conclude and/or stimulus taking time to take effect. A W-shaped recovery may be associated with initial lackluster stimulus and/or a second negative event, for example, a second wave of the pandemic occurring. A U or W-shaped recovery looks more likely at the moment. The potential for a second wave of the virus is of particular concern. Under this scenario, we envisage substantive volatility in markets with the potential for both risk assets and safe haven assets, for example, government bonds, going through boom and bust periods. L-shaped. This scenario is based on a recovery over a very long period of time or no recovery occurring at all. This is generally associated with individual sectors due to structural changes. With regards to the current COVID-19 impacts, such a scenario may be a result of a large number of businesses becoming insolvent, resulting in vast unemployment. Measures such as the UK furlough scheme have been put in place by global policymakers to try and avoid such scenarios. We would envisage safe haven assets, such as government bonds and higher quality securities, performing relatively better in such an environment when compared to other riskier assets, with the potential for insolvencies as company reserves become depleted. In order to put recent performance into perspective, on this slide we show the recent fall in equity markets relative to a much longer term timeframe. Investors should seek comfort in their ability to weather such storms. Drastic government and central bank policy have been implemented to try and stabilise markets, whilst only time will tell how equity markets will react to such measures. These increased bouts of volatility are expected to remain until COVID-19 fears subdue. Many investors will see this market crash as an investment opportunity, especially those with long investment horizons. However, some sectors may significantly outperform others, particularly over the short term. What are the implications of this on investment strategy? Now, arguably, more than ever, investors should understand the benefits of a diversified portfolio. Markets have entered into a wait-and-see phase as to whether the shift in market sentiment is temporary or if what we are witnessing is more of a structural shift. The current economic landscape will inevitably lead to market opportunities. However, protection of assets over the coming weeks and months should remain at the forefront of investors' minds. I hope this quarter's vodcast has been informative and has provided you with a broad update on the current economic climate, although this is ever changing. If you have any questions, please feel free to get in contact with the Quantum Advisor investment team. With that, I'd like to say goodbye until next time, and in the meantime, stay at home, protect the NHS and save lives. Thank you.